Hello, I'm Jonathan Moyes, Head of Investment Research at Wealth Club, and today I'm with Richard Manley of Seneca Partners to talk about the Seneca Growth Capital VCT. Hello Richard, welcome back to the studio. So we're here to talk about the Seneca Growth Capital VCT. Firstly, what is it? What makes it different, and why should investors consider it?
Hey Jonathan, well, great to be here. Thanks for having me along. So yeah, in terms of USPs and points of difference with the Seneca Growth Capital VCT, there's actually a number where I think we are different to those in the market. The first one I'd highlight is probably in the portfolio composition. If you consider that for just a second, we've got 28 companies in our portfolio right now. And actually, there's quite a healthy balance of AIM exposure in there. So I think if investors are sort of looking at the AIM market and thinking that could represent some value, some of our investors actually think that the value of AIM stocks has actually fallen a little bit too far and make us, this is a good time to re-enter a VCT which has got a material AIM exposure. Then the Seneca VCT is certainly a VCT they should be considering. In terms of other USPs, we're a Manchester-based house. We know that obviously a lot of capital in the growth cap space flows in the southeast, but we're Manchester. That is a key point of difference. We like to think we see different deals. We've got a good exit track record. I know that's very important right now to investors across the growth capital space. We've got a good dividend track record, paid 3p per year since we launched in 2018. I'm run by a seasoned management team. So myself and my co-founders at Seneca, we've been with Seneca since inception. We provide stability in terms of decisions and investment decisions we make. We're entrepreneurs ourselves. We've grown businesses and exited businesses, so we like to think we know what entrepreneurs are looking for in terms of support, both capital and sort of intellectual support. And in terms of our commitment to the VCT, in terms of pound notes, myself and the senior team, the wider team at Seneca, have got more than £1.4 million invested in our VCT. So it's not just a story for us. We've very much put our money where our mouths are and like to think we've got conviction in our investment objectives.
Very good. And so taking a step back, for those who aren't familiar, who are Seneca Partners and what's your role there?
Yeah, well, I'm the CEO, Jonathan. So since we founded the business in 2011, we've been developing the business. It's now grown to become a diversified investment management business. We've got about £250 million of assets under management across three principal areas. So we've obviously got the growth capital space, which is our EIS and VCT investment activity. And we've also got a debt business, two debt businesses in principle in our debt arm. One of those is a trade finance business. So we provide specialist stock funding lines to UK SMEs. And then we've also got a property finance business where we provide short-term bridging finance and development finance to UK property developers. And then the third arm to our business is our commercial property investment business. So this is quite a fast-growing area of the wider Seneca business right now. We've got a specialism within the flexible office space. So we currently run 15 flexible office centres across the UK, 500,000 square feet of office space in more than 500 tenants. So quite a high conviction area for us right now, given the attractive entry prices which are available in the UK commercial property market, particularly the office sector right now.
Turning back to the VCT, what sort of companies do you look to invest in? And are you more of a generalist investor or more of a sector specialist?
No, absolutely. We're generalists, but we're generalists by design. In terms of that approach, what we don't want to do is sort of restrict ourselves in some of the investments we look at. So when our team and we're looking at a great investment, we don't want to be restricted from our ability to transact that based on a set of rules we might have determined 3, 4, 5 years prior to the current opportunities. Having said that though, there are certain characteristics which we look for in our investments. So for instance, probably first on that list would be the strength of management team. So in terms of assessing our investments, strength of management team is a key component. Scalability is another one. As is your sort of defensible market position. We're looking for USPs and defensible positions in these businesses which we back. We want good demand drivers in there. And also we want a path to profitability. They don't need to be profitable at the point we invest, but we certainly want a clear path to profitability. And then on those, we like to know where the exit's coming from. We like to think about the exits when we're going into these investments. So that's an important part for us. And then these investments need to be available on terms which are appropriate. So just in terms of the investment dynamics themselves and investment structure and valuations, these are all characteristics that we're looking for when we're selecting our investments.
So how do you find these investments? And then I suppose once you found them, how do you win the deals? And You mentioned Manchester based. Is that is the regional focus a key theme for Seneca?
Yeah, absolutely. I think it does give us an edge. We talked about USPs earlier. I think it does give us a point of differentiation in what is quite a crowded VCT landscape. We're based in Manchester, so we are naturally strong in the regions of the UK, particularly the north and northwest, where we've got a senior team with great networks. So we see a lot of deal flow out of Manchester and the northwest. Having said that, though, of course, we see the wider deal flow as well. We're regularly down here in the southeast. We know a lot of capital flows here in the southeast, particularly in the tax advantage space. So we're here a lot of the time as well, so we see deal flow. And I mentioned as well, we've got a material AIM exposure in our VCT. So we're obviously networked with all the brokers. We do see all the public market activity. So I think between our sort of naturally strong northwest presence, the private market stuff we see, and then the brokers, I do think we offer our investors that sort of full visibility in terms of deal flow in the UK.
So turning to recent investments, could you give us a few examples of investments you've made in the VCT?
Yeah, sure. So been quite busy this year. So I'll probably highlight one of our private investments we made in the summer is into a business called Forma-Care, which is a sort of NHS supply business, supplying adult sort of incontinence and sanitary products into the NHS. Really nice business. We led an investment round of circa £1.3 million into this business. I think the key feature of this business worth calling out was on the way in. We looked at business with strong management teams, as I mentioned before, and on that investment, the incoming chair was actually a sort of more of an exec chair, certainly that's the role he's going to take up post-investment, invested material amounts alongside us, into the, a couple of £100,000 worth. So that, to me, is a really key endorsement of that investment opportunity. So yes, we led the investment round, but supported by the chair who was really putting a sizable capital commitment in there. So that business has made really good progress over the summer months. We've only been in it sort of 4 or 5 months, but already they've got supply chain set up with 3 NHS hospital trusts. Their point of differentiation is a good supply chain out of China. So they're able to source higher quality products at lower cost points, which provides them a better margin, but also enables them to undercut the current suppliers into the NHS. So ultimately, they're saving the NHS money as well. So that combination of supply chain dynamics with a better price point into the NHS provides a real competitive advantage. So that business is maturing very well, progressing nicely, and looking like it will turn to EBITDA positive within the first 12 months. Since the point of our investment. So a real good example of the type of businesses that we can source off market. This is based in the north of England. So a really good example of the type of businesses we can find in the regions and with a clear path to profitability, which was key.
Good. Any other examples?
Yeah, sure. So, I mentioned that we do AIM investments and we do private investments. Forma-Care is a good example of a private company investment. But we also topped up into a company called Optibiotix, which is an AIM-quoted business. It's a consumer health business specialising in the human microbiome. So we're all aware of the increasing importance of gut health and this sort of thing. And Optibiotix is a great example of that. It's a business we've actually known for more than 10 years. We backed the IPO some time ago. We've done very, very well off our investments in Optibiotix over the year, providing great profits to our investors. But it's a team we know work well, we trust them, we work very well with them. And they were actually raising further capital just as recently as this summer to take another product to market. So of course, we keep in touch with that business, we know how they're progressing, and it's an area we really believe in. So we're more than happy to support that round. They were sort of topping up with a £1.5 million fundraise. We're more than happy to jump in and support that round. So, we've actually managed to already harvest a little bit of profit out of that investment because of course it's quoted on AIM. So, we know that AIM can provide excellent liquidity on investments. So we've already seen that sort of come through in terms of that investment. So so quite excited about the future for Optibiotix as well.
Good. And so turning to perhaps some of the more established holdings in the portfolio, any key examples there, any highlights? Yeah,
probably worth highlighting perhaps firstly one of our private investments, which is an investment called Bright Network. So this is a graduate recruitment platform. Sort of work as an interface between the graduate workforce and then the corporates who are looking to hire that graduate intake. So this is a business we're a co-investment in there with Maven. So first invested in the business some 3 years ago. So we look back to where the business was 3 years ago. It was a sort of UK-centric business, turning over in the region of £3 million and still obviously EBITDA negative as it was investing in its growth. If you think about where that business has moved to now, turnover is north of £15 million. It's EBITDA positive. So it's a great story, progressing really nicely. They've recently signed up their 1 millionth graduate onto the platform. So you can sort of see the growth and feel the growth in that business. So making good progress. A very well-funded business, actually. An important point across all our EIS investments is their funding runway, giving them excellent runway to sort of execute their business plans. So well-funded business, nice growth trajectory, doing well in the UK and now eyeing up Europe as well in terms of the next expansion. So a good example there. of a business which is growing quite nicely. In terms of calling out perhaps a second example for you, we've invested in a business called Convenient Collect, which is also trades as HubBox, which is a software solution which sits on e-commerce websites at the point of checkout and provides consumers the ability to select either home delivery or having their parcels or e-commerce item delivered to one of these lockboxes you'll see in petrol forecourts and at the tube stations and so on. That choice is key. The retailers now, they need to be able to offer this flexibility. Not everybody wants their parcels delivered to home. Some want them delivering to a convenient location to pick those up. So this business partners with DPD and UPS, the big delivery networks, to ensure that offering is embedded with e-commerce, the e-commerce providers' websites at the point of sale. So progressing really nicely. As I say, ARR developing really well in that business. It doubled. We invested first time probably a couple of years ago. It's doubled in the time we've been in on a really nice growth journey. So again, showing some of the fundamental things we look for in terms of scalable business models, high growth business opportunity, good management teams, quality execution. So they're just a couple of examples there of businesses that show that.
And when you back these companies, to what extent are you getting involved?
Yeah, well, we're not operational. I don't think any VCT manager would sit here and say they're operational. I don't think anybody is. So I think really where we can add value, and we do add value, is in sort of three key strategic areas. So obviously there's the post-deal investment monitoring. There's the ensuring they've got enough cash runway to execute on the business plans. And then there's exit readiness and exit planning. So in terms of monitoring, going back to that one just for a second, this is about making sure these businesses are operating in their tram tracks, their chosen field, their chosen area of expertise. They've set out a business plan. We've bought into that and provided capital to support that. But it's about making sure they develop in line with that business plan. And we've seen businesses move through that journey. We know their challenges will come and we can help and monitor these investments. So that might be board observer rights, joining a board, or holding our own companies to account in terms of investment presentations and management meetings and site visits to make sure that we are challenging businesses as and when needed. The second point there was ensuring they've got appropriate cash runway. Again, it's a strategic item where I think we do add value in terms of challenging these businesses and making sure they're well funded. That's the most important thing. These businesses, the ones which don't work out, which occasionally happens in this space, they don't not work out potentially because it's not a great business idea. Often it is, but often it's underfunded and they run out of money, and that's what causes problems. So strategically, I think it's important that we add value and make sure these businesses are funded either through bringing an advisor in to lead the next, maybe it's a Series B or Series C round which is required, or indeed leading a further fundraise round ourselves. So a couple of ways in which Seneca help our investee companies. And then the third point is exit readiness. We all invest in these businesses. Exit seems to be even more of a premium in recent times in this growth capital landscape. So it's about working with these companies to make sure they're ready for exit, whether that's bringing an advisor in to work with them on that exit planning, or streamlining the business and positioning it for sale. These are areas where we challenge management teams and make sure they are well prepared for what's coming ahead.
And you mentioned exits there. Past couple of years, it's been a really challenging time for, I guess, the whole industry in exiting businesses.
Yeah.
How have you found the environment? Any recent exits within the VCT? How's the current environment looking? Yeah,
it's good. In terms of our growth capital activity, we've continued to exit investments. So exits are one of our key USPs and key strengths at Seneca. I know some of the wider market are challenged in terms of exits. And I think some investors are sort of bemoaning the lack of liquidity and lack of exits. We're quite fortunate in Seneca. That's one of the key themes on the way into an investment, to make sure we've got eyes on liquidity in the exit. So our most recent exit was as recently as October, so just last month, from our growth capital investment business. So this is actually an EIS investment, but obviously it's the same investments we'll make with the VCT. This was an investment we did in conjunction with Connection Capital, the London-based investment business, 23.5 Degrees. So this was a chain of Starbucks, sort of rollout. So we invested 1.5 million in that deal back in 2015. And that's it's just returned more than £10 million of exit proceeds. So, and that's as recently as last month. So, one of our best ever exits, and obviously, very well received by Seneca, and even better received by our investor base, who, as you say, they seem to be pushing more and more for liquidity. They want to see exits. They want to see the capital turned over. So we're good at doing that through the private companies, and this exit from 23.5 Degrees is a great example of that. And then, of course, we obviously invest on AIM. For some people, they like that strategy. Some people won't, but for those that do, it does offer that liquidity. So over the summer, we managed to exit. Another example is Transense. This is an investment we made a few years ago. It's a testing and control and measurement business. That was quoted on AIM. We invested about 700,000 and not quite as successful as 23.5 Degrees, which was a 7-8 times return. This is more than a 1.6 times return. So taking sort of 1.2, 1.3 million pounds out of that investment just as recently as the summer. So I think that sort of AIM USP puts Seneca in a good place to drive realizations, and equally our private company activity does drive realizations. And as I say, I think it puts us in a good position versus the peer group at a time when exits are a premium.
And turning to risks, I guess if you mention returns like those, you've got to also barbell that with risks. How risky is your VCT? And when you speak to investors, how do you describe the risks?
Yeah, well, I mean, risk is on everyone's lips. It's quite right in this end of the market. The tax reliefs in VCTs and the US for that matter, I give them for a reason. It's because the risk, the risks are there, and I think they're well understood by the investment base. So yes, the risks do exist, but I think investors have the opportunity to manage that risk themselves through diversification. We certainly talk to our investors about sharing or spreading their VCT investment between one or two, or maybe more VCTs as they see fit. And also then, in terms of managing risk within the VCT, this comes down to the characteristics I talked about a little while ago that we look for an investment. So is it led by a seasoned management team who've got experience in delivering business plans? Has it got a long cash runway? That's one of the key features for us when we go into these investments. Has it got a good chance of having enough runway to execute on its business plan and get itself to the next milestone and perhaps the next fundraise at perhaps an improved valuation point? And is there a clear path to profitability? These are characteristics which de-risk the investment activity we undertake. So these are always quite high up in terms of our decision-making process when we're trying to manage the risk within the portfolio. And the other obvious one is diversification. I mentioned at the outset, we've got 28 investee companies in our VCT right now. They're diversified by sector and also by public and private. So I think the more diversification you can introduce into a VCT, I think that's better for investors because of exactly the reason you ask about, which is managing risk.
And on the AIM allocation, AIM's clearly had a torrid time over the past couple of years.
Yeah.
It feels like IPOs and placings on AIM have also fallen as the market's fallen. Is that a challenge for the VCT? Does it change the way you look at AIM? Does it change where you see that you might deploy capital in future? Yeah,
absolutely. It's given we've got that, as you say, that sort of hybrid strategy between AIM and private, or have had historically to this point, and it's actually served us very well over the years. Absolutely, we are acutely aware of the challenges which have been faced by the AIM market generally over the last couple of years. That has impacted on our NAV and our net asset value. But ultimately, AIM has now got to a place where some people believe there's merit in investing in AIM because of where it is in terms of the value cycle. But in terms of our investment strategy, we run a hybrid strategy for exactly this reason. We're hybrid between AIM and private. So right now, we can just sort of lean towards private companies while we're waiting for the AIM market to settle down. I think we've really positioned ourselves in terms of, never say never. We're absolutely open for business and on the AIM market. We think there's good value to be had there. But I think the bar can be increased. And I think we can take that position where we can pursue our private company investment activity and then cherry pick the very best AIM investment opportunities. So I think we can still offer a USP, a point of differentiation through a very carefully managed selection process in terms of AIM investments, whilst leaning perhaps towards our private company investment activity whilst the market stabilises.
So would you say you're consciously reducing your allocation to AIM when you're deploying that new capital?
I think it's a natural outcome of just where we see the investment, the best place to put capital for the time being. As I said, we topped up on an AIM company just as recently as the summer, so we do pick off AIM investments, and we still see merit and good value in doing so. But I think equally, by the weight of capital deployed, Forma-Care, the private company investment we did over the summer, that was a £1 million allocation. So just by weight of capital, I think we are sort of leaning towards private company investments. But absolutely, we see all the public company deal flow, and we continue to pick off what we consider the best AIM company investments.
And are you waiting for anything in particular to start reallocating into AIM?
Well, I think as time passes, I think there has been some macro headwinds. Obviously, we've passed the Labour budget now. We've seen the US election come and go. I think interest rates are starting to reduce. We've seen a couple of cuts in the last 2 or 3 months. So I think this will start to change the dynamics in terms of people moving perhaps back towards a risk on investment approach, whereby, if interest rates on their cash accounts are dropping, human instinct tends to sort of drive people back towards looking at other investment opportunities. And I think AIM will sort of be a good moment in time. So that might take, 9, 12 months, perhaps longer for that to shift. But I think you can now start to point at things that are happening in the macro economy that should drive a little bit more buoyancy in the AIM market.
So to sum up, Richard, for those who are looking to back a VCT this year, why should they choose the Seneca VCT?
Well, we just talked about AIM for a moment. That is a key USP. It's something they should consider. If people are out there thinking that AIM represents value, if that's their market outlook, then when they're investing in a VCT, why wouldn't they want their VCT to also have some AIM exposure? So really that's down to the investors' individual conviction and what they believe in, but it's a point of differentiation we offer to the market. So if they do believe that AIM represents some good value or could do over the next 6, 9, 12 months, then Seneca absolutely should be at the forefront of their thoughts. And equally, I mentioned at the outset, the dividend track record is there for everybody to see, 3p a year since 2018. We've got distributable reserves available to support that on an ongoing basis. We're heavily invested in our VCT I mentioned. We've got £1.4 million from the Seneca team invested in the VCT. Got a great diversified portfolio. We're based in Manchester. That is another point of differentiation. We see the deal flow out of the north of England. We're good at curating private company investments that perhaps they wouldn't see if they stick to, let's say, the more traditional VCTs that they're used to investing with. So I think there's enough points of differentiation that if people are looking for something different, looking to diversify their risk, then absolutely Seneca VCT should be part of their thought process.
Richard Manley of Seneca Partners, thank you very much.
Jonathan, thanks for having me.
If you're watching on YouTube, please press like and subscribe to the channel for more.